Previously, in part 1 of my coverage of UTG, we looked at its flawless payout history. And now it's time to look at the bull case and bear case for UTG, as well as pricing, or how I decide when to buy and sell it. A quick disclaimer, I'm not a financial advisor, I'm just sharing my personal experiences. Always do your own research before investing. If you haven't watched part 1, then obviously watch that first. I'll link in the description. Let's dive straight into the bull case. Here are some factors that suggest that UTG is likely to be a good investment in the future. We have to assume that a recession is likely to come, and in that scenario, the 4 things that people cut last are food, housing, utilities, and their phone. UTG covers the last of those 2, utilities, and to a lesser extent, telecommunications. Their portfolio holds over 40 stocks, none of which exceed 5% of their portfolio. And those utilities cover several areas, but by far the largest focus is on the generation and distribution of electricity. So to make my point about utilities in a recession and their ability to have resilience, let's compare it to EPR. That's a REIT that focuses on discretionary income, in this case, spending on leisure time. In part 1, we saw how UTG sailed through the 2008 recession and the pandemic without any distribution cuts. And by contrast, EPR is a REIT that focuses on experiential tenants. What do I mean by that? They lease space to tenants like AMC Movies, the cinema company, and Top Golf. They have driving ranges. If we look to the 2008 recession, well, EPR suffered a 23% reduction in distributions. And I should explain that this next point here wasn't actually a cut, that's just when they changed from quarterly distributions to monthly distributions, so we can ignore that. If we look forward then to the pandemic of 2020, the news was horrific, and you can see that distributions weren't cut, they were completely eliminated. Let's continue the bull case by talking about inflation. Utilities are usually a monopoly. If a customer doesn't want to pay their power bill, well, usually they don't have a choice because there's no competitor. And when it comes to their phone bill, they may have some options, but generally it's not a very competitive environment. And these regulatory moats around utilities are what gives them pricing power. So even though utilities face rising costs just like everybody else and every other industry, they're better positioned to pass on those costs. And as an example, you can see here that gas prices were passed on at a similar rate to the rate of inflation, and electricity prices actually increased more than the overall rate of inflation. So I would argue that investing in utilities can act as a hedge against inflation. The third factor that suggests that UTG is likely to continue its steady course is the experience of its management team. UTG's 2 portfolio managers have experience that predates the 2008 recession. They joined Reaves, the company that owns the fund, in the years 1995, that feels like 3 lifetimes ago, and 2004. And the 4th factor that makes me bullish on UTG applies to the entire utility sector, and that is the Inflation Reduction Act of 2022. That piece of legislation contains significant government subsidies, including tax incentives, that will apply to a lot of the utility companies within UTG's portfolio. Before we move on to the bear case, my number 1 source of information for this video was analysis articles from Seeking Alpha. If you don't have a subscription, I'll put a link in the description. Okay, let's move on to the bear case for UTG. Why would you not invest in it? Well, looking at historical returns, you could get a higher total return if you invested over the long term into one of the funds I mentioned earlier, which is Vanguard's ETF called VPU, and that tracks a utilities index. Now, when I say total returns, that's an assumption that dividends are being reinvested. And on that basis, VPU historically would win over a 10-year or a 20-year timeline. Now, this isn't a knock on UTG specifically, it's just that over the long term, growth typically beats income. And that's because it's riskier. And that's because UTG has a higher yield than VPU, so that means you're getting your cash back sooner. Assuming you want a steady income, currently VPU pays a yield of just 2.98%. So for that to pay your bills, you'd have to invest a huge amount into VPU. Let's say you didn't do that, you invested a moderate amount in VPU, and the 2.98% is nice, but you need to spend more of that on your monthly bills. Well, the only way to do that is to sell some of your VPU stock. And if the market's going up, that's pretty easy. The problem, of course, is that if when you need the money, the market's going down. And in that scenario, you might have to wait, possibly years. So if this is money for retirement to pay your monthly bills, then that wouldn't be necessarily an ideal scenario. On the other hand, UTG is yielding over 7%. So if you were using that yield to pay for your monthly bills, then it doesn't really matter what's happening to the stock price, whether it's up or whether it's down, because selling shares of UTG is not part of your strategy. So if I were to generalize, I'd say someone like me who's retired is going to be drawn more to UTG, and someone younger and with, say, a 20+ year timeline is going to be drawn more to something like VPU if they want exposure to the utilities sector. If we combine a recession and inflation together, that's probably going to lead to more households being later on paying their utility bills. And this increase in accounts receivable would reduce the profits of utilities. Now, my counter argument to this is just that, relatively speaking, this is less of a problem for utilities than it will be for a lot of other sectors. And the last negative in the bear case for UTG is interest rates. Utilities are capital intensive. It costs a lot of money to build and maintain all that plant and equipment. So as a sector, they tend to carry a lot of debt to pay for all that. So as a result, the current high interest rate will have an effect of squeezing the profit margins of a lot of these utility companies that are in the UTG portfolio. And as for the UTG fund itself, they use debt, as I mentioned earlier, and the cost of that is going to be relevant, especially given that 100% of their debt is variable. Now, that's somewhat mitigated because UTG has reduced their leverage down to 17.88%, which compared to other CEFs is relatively modest. So high interest rates will have a negative impact on earnings, but I would argue that it's reasonably manageable. Is now a good time to buy UTG? Well, that depends on when you watch this video. This is how I look at when to buy UTG or other CEFs. As I mentioned earlier, the price of a CEF is set by the mood of the market, not specifically by the value of the underlying assets that it holds. And in this way, CEFs act more like a stock than a mutual fund. And if we look over the past 12 months, we can see that UTG has spent about half of its time trading at a price that's above its net asset value, and about half the time trading at a price that's below its net asset value. And on average, this comes out to almost zero. In fact, it's traded at a slight premium of 0.2%. And as I record this, it's slightly below that at negative 0.46%. So it's currently trading at a very slight discount to its NAV, and based on the historical average, this would make it slightly undervalued. Now, historically, if you've been patient, then it's possible to pick up UTG at a better discount than negative 0.46%. Over the past year's been pretty good, for example, in terms of buying opportunities. It's dropped down to negative 2% 4 times. Although 2 of those times were so brief that you would have needed to set a limit order in order to capture that low price. Now, if we zoom out to a 3-year premium versus discount chart, we can see that UTG was trading at a premium to net asset value from May 2020 to March 2022. That's more than a year and a half, so sometimes the wait to get a price below the net asset value can be a long wait. By the way, that handy chart we just looked at is from CEF Connect, and that's a website that is my go-to for CEF-specific information. It does that for free, and I'll put a link in the description. Big picture, I like to own UTG in bear markets when it's yielding 7s and 8s, and sell it during bull markets when the yield's in the 5s and 6s. Having said that, everyone likes to get a good deal on a stock, and the market's so negative right now that I've been trying to score a great price for UTG. Now, during 2023, there could be some price drops that will present great opportunities. But to bring you up to speed on what I've been doing recently, over the past year, the lowest possible price you could have scored for UTG was $25.22 in October of 2022. I had a buy order in October at just over $27, and I scored some at $27.07. So I didn't get the absolute bottom, but near enough, and that gave me a yield of 8.42% on cost. So my take on UTG, as you probably guessed, is it's one of my all-time favorites. There's a long history of resilience during difficult times, and there's consistent growth in distributions. Utilities are a fairly well-known safe haven during a recession, so my plan is that the worse the recession gets, the more I'll pick up. So that wraps it up for the Reaves Utility Income Fund, UTG. More armchair income coming soon.